Thank you for joining us today for our HAYVN halftime about raising equity to grow and scale your business. So what we're going to cover today is an overview of the early stage equity market, talk about sources of equity capital, answer the question, how do you know if you're ready? Talk about crowdfunding, how you should prepare, and how to think about valuation. So just to get started, venture capital financing is usually all over the news and certainly has been. The latest statistics sort of that close out of 2021 show that 2021 was just a historic off the charts year. Every stage of financing topped the charts. And 2022 has started out strong. I think the first quarter was relatively strong. I think what we're going to see in the second quarter is a slowing of that number, probably across most of the stages, but still relative to where we've been in the past 5 years. If you look at this chart to the left, you'll see still very healthy investments being made. For the topic that we're going to talk about today, which is really focused on early stage investing, that's when we're talking about angel or seed. And that has been just growing like crazy. And I think 2022 is still showing large quantities of deals done and high deal volumes. So you can see this chart is really only includes 2022 for the first quarter. But what I'm seeing beyond that is a little slowdown, but not as much as the rest of the later stage sectors. So that's all to say that the market is quite vibrant for angel and seed financing, which leads a lot of my clients to say to me, well, why does it seem so hard to raise capital? And we're going to talk about that. So the average round size for angel and seed rounds has been growing a bit. I think your first round, which we call sort of an angel round, has inched up to be about 700,000. Some of this, you'll see the seed round has been inching up to, I think for 2022, your average seed round, which is really where you're going to a more institutional audience, is about just over 2.5 million. And valuations have been trending upward too. So some of this is obviously some supply and demand part of the equation, probably a little inflation as well. But looking into what the statistics we're seeing for 2022, the valuations for angel investments, which is really the first piece of possibly valued funding, is up to about a $12 million range. Which is really quite high. And similarly for seed stage, it's really looking kind of right on top of that, which probably means that in this data is baked some very highly valued angel round companies. But even if you just look at where the lines were trending as of the end of 2021, your average angel company, and this would be post-financing, so it includes the impact of the amount raised, about 7 million or 9 million for a seed round company. And why I talk about this a lot, and this is, this ties to something that we spend a lot of time talking about at HAYVN, is the investment into women-led businesses. It does continue to rise, and this ends up a headline that we often see. And if you look at the chart here, you'll see clearly in the last decade, both the number of deals and the dollars invested in women-led businesses does continue to rise. Continues to rise. And yet, the percentage of those very large amounts of funding that went to all female founded companies was about 2%. So the blue line across the bottom. So of the very many billions that get invested, about 2% goes to women. Slightly better is the percentage that goes to companies where a woman would be one of the co-founding or C-level teams. Then you look at the yellow bar or the yellow line, which is about 15.5%. Still, this is one thing that we are very committed to having an impact in, And a lot of the work that I've done both at the SBDC and along with HAYVN is to try to move this needle. If we can't move the big needle, we can at least move this needle locally. So I'm going to start out here and just talk a little bit about level set the stage on what is equity capital. So when we think about raising capital for your business, it generally fits into two categories. So debt is thinking about borrowing money from a lender that you're going to have to pay back over a specified length of time at a specified interest rate. And equity is when you trade ownership of your company for capital. Now, when you think about debt, the pros are that you retain control of your company because you haven't given up any ownership interest. You can generally repay that debt on a very flexible way. Could be 1 year, could be 10 years, depending on the loan, depending on the lender. The con is that you do have to pay it back. There are interest payments all along the way, and you need to factor that into your business. For some startup companies, that is a non-starter because they're pre-revenue and don't have the ability to fund into that. And the risk, of course, is that if you are unable to pay, you could lose your business. You could lose any assets that you've created in your business, including trademarking, some of the intangibles. If you've developed technology, you could lose that. And so, we also like to think about it from a personal standpoint, so that to the extent that you're borrowing money to support your business growth and you're a first-time founder, you are very likely to have to give a personal guarantee for that loan as well. So you're putting your own personal finances on the line. So equity has a lot of pros, and a lot of people end up thinking, well, I don't want to do debt, mainly because of the con or the risk that I've noted there. So equity, when we think about trading ownership in your company for capital, you don't have to make interest payments. If the business fails, there really isn't a recourse to you. It may not be pleasant, but they're not going to come after the business or you personally. The con is that you do relinquish some decision-making. And I think everybody probably can think about stories that they've heard in the news when a founder raises so much equity that it's diluted their ownership from the 100% the day they founded the company down to below 50%, at which point they don't have control. And key business decisions can be made without them or around them, or in contrary to what they would like to have done, and they can be replaced. So those are the risks of raising equity. And the other issue that's just a practical one is that it can be very exhausting to raise equity. My own background is prior to these roles, I was a banker for 20 years, and part of what I was doing for the last half of that was raising capital for very small companies. And I would tell them to raise equity funding for, a Series A. We would be making 150 calls to firms and funds that were well qualified and interested in the segment that we were looking at. And our hope would be that we would get 20 to 30 responses of interest so that we could set up 10 meetings and we could get 2 or 3 indications of interest. So that should give you an idea of how exhausting it is and how you really do need to be prepared to hear a lot of no's. So if you don't have that kind of personality where you can hear no and move on to the next call, you have to think about that too. So in summary, when I think about the difference between debt versus equity, you want to make the decision of, are you more aligned with taking out a mortgage to fund your business, or do you want to get married? Because I do tell all of my clients who are looking at equity funding that it is very much like getting married. These investors are going to need to be with you in the good times and bad, when you're making easy decisions and celebrating, but also hard decisions. So key questions before fundraising. I think that one of the conversations I have repeatedly with early stage entrepreneurs who are looking for funding is everybody seems to think, or most people seem to think, that funding solves all problems. And it doesn't, for a lot of reasons. I think that one of the things I see the most is clients who want to raise funding because they're not profitable. And that's obviously a problem because for two reasons. One is it's very difficult to get funding if you're not able to show, if you're not profitable today, that's okay, but a path to profitability. But what I say more often than not is we don't want to scale something that doesn't have a reason for being unprofitable or that isn't, right? So to put it more simply, you want to scale something that is a fully baked business model. And if there's a reason for you to be unprofitable right now, then we can listen to that and hope that investors will. But it would be a lot easier if we had a lot of the early stage growth questions sorted out so that we know that what we're trying to raise money and scale has been fully baked and that the lessons learned were made in the early stages. So I like to make sure that entrepreneurs have a really good sense that capital is the gating issue to them growing, because very often it can be something else. Like you don't have product market fit. You have a product that you've fully developed without getting market feedback. And so you're having trouble selling it. There are a lot of other questions to ask along the way. And then in deciding what kind of funding or how much to raise, we talk about how soon you need it. How much capital do you actually need to get to the next milestone? What kind of credit do you have? Because sometimes that will have an impact on whether debt could even be an option. And importantly, are you really just looking for a check to be in your bank account, or would you benefit from some advice or mentorship? Because equity funding usually comes with people who think that they would be good advisors or mentors. So you need to be the kind of entrepreneur who would welcome that. Importantly, are you ready to share your business and the decisions? Because that is usually a lockstep in your business operations. When you go from being a solopreneur where you're working on your own schedule, making your own decisions when you're ready to, or building a team and having investors that you need to report back to on what went wrong or right over the course of the month, quarter, and year. And then finally, how big do you want to grow? So investors, there are many businesses out there that are very successful that don't become a Facebook or a Google, and that's fine. But if you take on funding, those investors are going to want to see an exit and want to understand that you have a plan for that. So I have had clients who are looking for equity funding, and as they're in conversations with the investors, and the investors say, so what kind of exit are you looking for? And the investor says, or the entrepreneur says, well, really, I'm just going to have this business and pass it on to my children. Well, that's not what they want to hear either, because they only get repaid upon an exit, upon an IPO, upon a sale to a strategic or something like that. So you want to make sure that your growth goals are aligned with the kind of financing that you're looking for. So how do you know if you're ready? And this is a slide that I show to people weekly. And is in most of the presentations that I do with early stage investors. There's a logical growth curve, and in this graphic, I've used sort of a stair step modality to show a typical business growth process. And that's not to say that we don't go from one step back to another step before taking a few steps forward, but think about it with me, starting from the bottom left with the light bulb. And most entrepreneurs wake up one day with an idea and go from that to a discovery phase where they kind of test this idea with others. They're talking to their friends about it. They're talking to people who may have the same, the same set of problems that generated the idea. So we call that the discovery phase. You sort of suss it out among people that you feel comfortable with. And then if you get to the point where there's some momentum around it, you're looking for validation from customers. So is this something that not only has, that you can gather data that supports that this is a good idea, that customers will actually buy it? And then from that validation stage, the concept of people, customers eventually buying your product or service, the customer acquisition phase is when you actually test that that happens. That not only are they willing to buy it, but they're willing to buy it at a price point where you can make money. And then from there, the growth and scale phase is once you've already validated that your product fits the market and attracts customers who are willing to pay for it enough money for you to make a margin that that is sustainable and attractive. From that, you grow and scale that. And along the way, as I said, you may go back and forth and up and down and go between discovery and validation. But this is what everybody hopes will happen with their business. And there are very logical sources of funding for most of these categories, most of these stages of growth. Now, at ideation, really probably nobody is going to fund you except maybe your mother, right? Like everybody's who's been a kid has a lemonade stand and their parents probably supported that. But the ideation phase, you're pretty much going to be on your own. When you're in the discovery phase, then you're still probably not at a phase where you're feeling comfortable going out and asking people for money. And hopefully that's a good thing because you're unlikely to be successful with that either. There are grants, there are competitions, and I think about these kind of like Shark Tank, or we have HAYVN Hatch coming up in the fall is a good example of these, where you get to sort of test drive your product idea or your business idea in front of an audience, in front of people who you think either are like-minded or you can convince them to put themselves in the shoes of somebody who would think this is a good idea. So you call that the discovery phase. And the likely sources of capital are, kind of grants and competition. Once you've gotten past that and you feel like, yeah, I think I nailed it, and you move on to the validation stage, the likely sources of funding are kind of crowdfunding, which we're going to talk about a little bit later, friends and family funds, which everybody, thinks is, that's been going on since the 80s. We can talk about that. And then I'm going to introduce the concept of an SBIR grant, a Small Business Innovation Research Grant. That's a US government grant that is designed to help entrepreneurs solve discrete problems that our government cares about. So they typically will publish a list, an exhaustive list of things that they care about. And if your idea fits that model or attempts to solve a problem, you can apply for a grant. It is something that we do a lot of work with and have great resources to support entrepreneurs with. It is a narrow niche of problems that the government's going to pay for, but when they care with deep pockets, and it can be a great source of funding to solve exactly the kind of questions that you're going to have trouble raising funding for otherwise. So then when we move on to the point where we have a product that works, that customers have indicated interest for, when you need money to actually prove that out, you move to the customer acquisition phase, that is when angel and seed funds would logically be looking and interested. And from there, venture capital is really there to help you scale. So there is a little bit of I think, a misalignment in how much press the venture capital world gets for being risk takers and innovators. And I've had a lot of clients get a little discouraged by the fact that they don't actually take early stage risk. From the amount of press that you'll see that the VC community gets, you would think that they would get interested way on the left side of this chart. but they really don't. They're willing to take growth risk, but not customer acquisition risk and not product market fit risk. And when I think about why this chart is so important, it's because it's very challenging for entrepreneurs to be raising capital in addition to moving their business forward. And the reason it takes so long to raise the capital is usually that they're in the discovery phase talking to venture capitalists, where the answer is always going to be no. And you can waste your time talking to people who are going to tell you, yeah, I like your idea, but you're too early. Or you can look for people who are the most likely to say yes. And I think there are many, many lessons to be learned from this one chart. So if you think you're ready and you want to know what you need, this actually, I took a couple slides out of a presentation that I did a couple months ago at HAYVN, and that you can find videoed on the HAYVN YouTube channel. But you need three things. You need an elevator pitch that looks like this. This is sort of our template, and you should have an elevator pitch that you are doing literally in every elevator and shopping line that you're on until it comes out very smoothly. And because you just never know when you're going to meet a co-founder or a partner or somebody along the way who can be helpful to you. And you need a pitch deck. This is the entire topic for another halftime that we did a bit ago that you can find on the channel. But a typical pitch deck, and there's an article referenced on the bottom of this slide that I think is super key to doing your pitch deck once correctly instead of many iterations, is someone summarized all of the successful pitch decks that different venture capitalists have seen and highlighted that these are really the 12 slides that you'll need. You need your intro slide that introduces sort of the company and the vision. Every venture business ends up starting with a problem solution modality. So describing the problem that the entrepreneur found that inspired the need for the company. So start with your problem, introduce the solution, and then market size it. So we're going to try to convince the investors that not only is this a problem that's broadly identified or broadly agreed upon is a problem that's worth solving, but that the number of people that see that and agree with that and are willing to pay for it is a large and growing market. So that goes into the market sizing, which people end up spending more time on that piece of this puzzle than you might think. Then highlighting the business model. So how does this solution make money? And is that consistent with how people typically look for these services? I'm continually surprised, having been doing this for quite a while, how many things you can buy on a subscription model. And that has been a change that people have been able to leverage, both in terms of getting clients to agree to the subscription, but then investors also really prefer and prioritize things that can be, monthly recurring revenue. Then you talk about your traction, sort of where are you today? How did you get here? What are the key assets and accomplishments that you've already checked off the list? You want to understand your competitive market. It's very important that you are the expert in the market that you're competing in. And then you talk going forward, what's your go-to-market strategy from there? What milestones are you trying to hit next? And provide an overview of financials and your team that's going to get you there. So who do I call first? So I'm going to highlight, just answer the question quickly, and then we can talk about this later. So here in Connecticut, we do have CT Next is kind of the most important of our local state organizations that I think are super helpful with early stage companies, particularly who are fundraising. And I would look on their website. I would make sure that you're absolutely signed up as part of their organization. They have two things that I highlight for everybody looking for equity funding. One, I've mentioned on the page, the Entrepreneur Innovation Awards. They're usually done 3 or 4 times a year. And it's a super fun event. I always tell people to go to one before you then apply to be part of one. That way you can get a sense of sort of the type of pitch that typically does well in a large audience function like that. But they usually have, I think, around 8 or 10 companies pitching in a Shark Tank type of situation in person, thankfully now, to win a $10,000 prize. They also have something that can be helpful called the Angel Investment Tax Credit, which is for any, you need to apply with your company. And then if you're approved for this, any investor who invests in your company more than $25,000 can get a tax credit off of their Connecticut taxes. So it's a real cash back. It's a super thing to offer to your investors. There are a lot of local angel networks that you can apply to pitch at. And there's usually an application process. It's all digital now. I think it does help to do a lot of networking sort of around any of these applications. I'd like to also start with LinkedIn. As I said earlier, it's really important to know people who are investing in the sector that you're in. I will say most of my career I've spent helping people get funding, working for a bank, working for advisory firms. I very briefly spent 2 years at a private equity firm, and I was so excited to start this job because I thought I've been calling people like that for my whole career, trying to get them to invest in my companies. And now it'll be great to be sitting on the side of the table where we actually have the funding. And I was surprised at how hard it was, because we could really only invest what we had promised to our partners that we were going to do. So we had specific investment theses, and we had specific size of checks that we could write, and the companies had to be at a certain stage. And so it really put some context for me in understanding why you get no's so many times. So I tell people to do research into who's able to invest in your sector, in the kind of company that you are and at the stage you're at, so that you're not wasting anybody's time, including your own. So I think crowdfunding is also something that we want to talk about because it is a very viable way to get yourself off the ground. For anybody who doesn't know crowdfunding or hasn't seen a GetFundMe at some point, crowdfunding is basically funding a project by raising many small amounts of money from a lot of people. It's typically done online. It can be used to sort of jumpstart something that maybe is a bridge to doing larger funding. I will tell you, Felicia, who's the HAYVN founder, who isn't here with us today, but she was a client of mine when HAYVN was really just a PowerPoint presentation. And she was doing a larger funding to get the place off the ground, but in the very interim, to cover some of her initial funds, did a crowdfunding using the iFund Women platform, and it just helped her defray some of that initial costs. And if you go back to the chart I gave you earlier, it's for phases where, you know, maybe you would have a friends and family fund, maybe that's where you would go, or crowdfunding is really helping you with the very early stage when you're just beyond ideation. So I'm going to stop sharing and bring you to a good example of a crowdfunding that I really like. Let's see. It'll just take a minute, but I promise you it is worth it. Okay, hopefully you can all see this.
Changing the world was as easy as pushing a button. I'm Matt from Pila, and I want to introduce you to my friend Lomi. At Pila, we're a team of engineers and material scientists, and for the last 3 years, we've been creating something truly special, a solution to the world's garbage problem. Now, before I show you how Lomi is going to change the world, let's talk about why you're going to want one in your home today. Maybe you live in a big city and have a green bin program. You know, those little plastic bins with leaky bags under your sink that are amazing at producing smelly, gross liquid sludge that nobody wants to touch. Raccoons, anybody? Or maybe you don't have a green bin system where you live, and instead you throw all your food waste into the garbage, which then goes to a landfill, which produces methane, which causes climate change, all while still smelling pretty terrible. Lomi makes your life so much easier. Lomi can compost your food waste, that pesky packaging from your online shopping habit, even biodegradable plastics. Yep, Lomi even works on Pila's compostable phone cases, all at the push of a button. And as little as a few hours later, your waste has turned into the start of nutrient-rich compost, totally mess-free and odor-neutralized. You probably know us at Pila as the inventors of the world's first compostable phone case. Pila's customers have eliminated more than 41.8 million plastic bags worth of garbage in the last 5 years. To create Lomi, we've spent over 3 years completing more than 1,000 compost tests and endless hours of design and prototyping. Lomi isn't just beautifully designed, it is the world's best home composter, period. Food waste creates 330 billion pounds of garbage in North America each year. Packaging and plastic represent even more garbage, and add that number up even higher. Lomi makes food waste a thing of the past and helps you cut up to half of your carbon footprint, all while making odor-neutralized, mess-free compost that you can feed your plants, toss in your garden, send it to the green bin, or put it in the garbage. Together, we can do something that politicians and big businesses can't seem to take any action on, actually helping the planet. We can make trash a thing of the past. Back our project today, and you'll help us bring Lomi to life.
Okay, so I like to show that because Matt raised $500,000 in the first 4 hours after doing that video, and ended up raising $7 million on Indiegogo, which is one of the main crowdfunding platforms. Now, I have had a lot of clients in the past couple of years come to me wanting to do a crowdfunding campaign and quoting statistics like this, like it should all be just this easy. If I could raise $1 million in a week using crowdfunding, that would solve all my problems. And what I want to emphasize is the type of business that is able to do that is they're few and far between. And frankly, I think what Lomi has done is fantastic, but what they've done in addition to creating this product is they've spent a lot of money on that video. It's super concise. It was probably, that 2-minute video covered everything that you would typically put in a pitch deck except for the financials. So I want to set the stage, and that is what it takes to get kind of the mass market traction that a lot of people think they're going to get from crowdfunding. And it's highly unlikely that that's actually the outcome. So I'm going to walk through what the actual process is. Setting the stage, there are a variety of crowdfunding platforms. They can be looking for donations, they can be looking for pre-orders, or they can be looking to do a whole equity raise. Most of the time, what I see are the first two. So you're looking for a little bit of support that comes in to help you get to the next phase, but you are not trading any long-term equity along the way. What I think about who's successful and who isn't, the success of your campaign is highly correlated to your own personal network. Or you have a crazy innovative idea like Matt did. But for the most part, it's about your personal network, because the process that you use to get to your crowdfunding is first you choose a platform, and we're going to talk about some of the ones who are commonly used and available. Then we're going to hone your pitch, and maybe you don't get to be as good as Matt is on this, but you'll get as good as you can get. Then you need to map your network. So this is a boring process that you always do, about writing in how many people that you know, getting out of your contacts and putting realistic elements as to how much you think that they would likely contribute. So if you're somebody with a broad network out there, and you've been largely contributing to other people's crowdfunding or donations, then maybe you have a good sense in what they're likely to contribute to yours. But you're going to actually write out and come up with a pipeline of people. Then you're going to set rewards. This can be the things that you're pre-selling. And we generally like to have some $25 all the way up to what you think the max would be for your own network. And then you set sort of reasonable, realistic campaign goals where you are sending out the people that you know will buy first, and then segmenting your list and going from there. The way the platforms work, and here on the screen is a list of places that you could look to. Some you've probably heard of, like GoFundMe. I Fund Women is one that we like a lot around HAYVN. But Kickstarter's good, Indiegogo's good, Black Founders also. They typically work the same, and they'll take 5 or 6% of the funds raised off the top. And some of them do a better or worse job of offering other support services. Like I know for I Fund Women, they have their blanket process and fees, but if you need help doing a really good video, they're going to help you, and you're going to have to pay a little extra for that. So I think the how to succeed, the key is at the bottom, setting realistic campaign goals, and rinse and repeat. And you do it over and over again, just like any targeted marketing campaign. So I'm going to talk a little bit here about the Connecticut resources here that we have to help with equity raises. CT Next I've mentioned, and those are the two programs that I like the most. Their Angel Investor Tax Credit, as well as the Entrepreneur Innovation Awards. Then Connecticut Innovation, sort of their sister company, they have a lot of matched funding opportunities that you can think about. And that's something we can talk about in another webinar. At HAYVN, there is the Launch Accelerator, as well as some of these halftime speakers. I think Jen mentioned at the beginning that we've got a HAYVN Hatch competition coming. I think it's October 3rd, so you'll start to see that. And then I work over at the Connecticut SBDC, and my colleagues and I are great resources to help in the actual creation of the deliverables and helping to make sure that you're prepared for this equity raise process. So that is my contact information you need if you need it. We will be sending out this, this deck for you. And right now I will stop share. And if there are any questions, happy to answer them.